Silver has crossed a threshold Wall Street spent decades dismissing. Not gradually, not quietly, but decisively. At prices near levels last seen during the inflation crisis of 1980, silver is no longer behaving like a forgotten commodity. It is behaving like a market discovering scarcity in real time. Banks are repositioning. Inventories are thinning. Industrial buyers are no longer price sensitive. Yet consensus forecasts remain strangely anchored to the past. This disconnect is the story. For years, silver was framed as volatile, unreliable, and ultimately secondary to gold. That narrative justified low allocations, passive coverage, and modest price targets. But markets do not move on narratives forever. They move on constraints. And silver is now constrained in ways the models were never built to capture. The debate unfolding on Wall Street reflects that tension. Some analysts see a move toward $50 as a cyclical overshoot. Others argue $100 is plausible through ratio reversion and monetary tailwinds. A smaller group, often dismissed as extreme, points to scenarios where prices overshoot far beyond historical anchors. Not because of speculation, but because supply mechanisms fail under stress. These are not three different predictions. There are three different assumptions about how the system behaves when pressure rises. If the market remains orderly, paper claims roll smoothly, and physical delivery is rarely tested, then silver stabilizes at levels that feel familiar. If confidence weakens and physical demand begins to dominate price discovery, higher targets become unavoidable, and if the infrastructure designed to absorb stress instead amplifies it, prices cease to be forecasts and become rationing tools. What makes this moment different is not enthusiasm, it is positioning. Large institutions are not debating silver's relevance. They are adjusting exposure quietly. Sovereign actors are not speculating on price, they are securing supply. Industrial users are not hedging volatility, they are planning for availability. Price is reacting to behaviour, not headlines. This raises a more important question than whether silver reaches $50, $100, or $500. The real question is which version of the market survives the transition ahead. A liquid paper market built on confidence, or a physical market governed by mathematics. Understanding that distinction is the key to understanding where silver goes next. Silver's recent advance is often described as a breakout. That framing understates what is happening. The move is not driven by speculative momentum. It is driven by repricing risk that was ignored for years. At current levels, silver has exceeded every major bank forecast issued just months earlier. Targets clustered in the mid-30s were rendered obsolete without a macro shock, a recession, or a financial crisis headline. The price simply moved through them. That alone signals a modelling failure. Futures markets still dominate price discovery. Most volume flows through paper contracts designed for liquidity, not delivery, under normal conditions. That structure suppresses volatility. Under stress, it hides it. Prices appear stable until they are not. The key indicator is not spot price, it is inventory behaviour. Registered silver, the metal explicitly available for delivery against futures contracts, has declined sharply relative to open interest. Eligible silver still exists in vaults, but eligibility is not obligation. It can be withdrawn, reclassified, or withheld at the owner's discretion. That distinction matters only when confidence breaks, and confidence is increasingly conditional. Backwardation has appeared intermittently, an unusual signal for a metal with storage costs. Lease rates have spiked, reflecting short-term desperation for physical supply. These are not retail phenomena, they are institutional signals, visible only when metal becomes difficult to source at scale. Meanwhile, volatility metrics remain muted. Option pricing implies manageable risk. That contradiction is telling. The derivatives market is pricing continuity. The physical market is pricing friction. Wall Street's published outlooks reflect this split. Strategists continue to model silver as a cyclical asset responding to rates, inflation expectations, and dollar strength. Those variables still matter, but they no longer explain marginal price movement. Availability does. This is why forecasts keep lagging reality. Models assume that supply responds to price. In silver, it does not. They assume inventory buffers exist. They are shrinking. They assume paper and physical converge. They only do so when delivery is optional. The market is not panicking, it is repositioning. That is a critical difference. Panic is loud and fast, repositioning is quiet and persistent, and the price action reflects the latter. This is the stage where complacency is most dangerous. Prices feel high relative to recent history, yet low relative to structural stress. Liquidity still exists, which creates the illusion of control. But liquidity is not supply, and the market is beginning to treat them as separate variables. To understand where this leads, the next step is demand, not speculative demand, not investor sentiment, but consumption that does not pause when prices rise. That is where the pressure truly begins. Silver demand is no longer cyclical, it is structural for most of modern market history. Silver demand fluctuated with jewelry consumption, photography, and discretionary investment flows. Those drivers were price sensitive and reversible. Today's demand profile is different. It is embedded in infrastructure, technology, and policy mandates that do not pause when costs rise. Industrial use now represents the dominant share of annual silver consumption. That shift alone changes how the market behaves. Industrial buyers do not speculate. They procure. When silver prices rise, they do not liquidate positions. They secure supply. The largest driver is electrification. Solar energy is the most silver-intensive large-scale technology deployed globally. Each photovoltaic panel requires silver paste for conductivity. Efficiency improvements reduce usage per unit, but deployment growth overwhelms those gains. Annual solar installations have multiplied several times over the past decade. Government subsidies and net zero targets lock this trend in place. Electric vehicles add another layer. An EV uses materially more silver than an internal combustion vehicle due to power electronics, battery management systems, and charging infrastructure. EV penetration continues to rise, not because of consumer preference alone, but because regulation demands it. This creates silver demand that is political, not economic. Beyond energy, silver is critical to 5G networks, AI data centers, medical devices, and advanced defense systems. These sectors are expanding simultaneously. None have viable substitutes at scale. Silver's electrical and thermal conductivity are not engineering preferences, they are physical constraints. This matters because industrial demand does not respond to price signals the way investment demand does. When prices rise, investors may hesitate, manufacturers cannot. Delaying procurement risks production shutdowns, contractual penalties, and lost market share. In that context, price becomes secondary to availability at the same time. Silver's monetary role has not disappeared. It has been dormant. In periods of currency debasement, negative real rates, and expanding sovereign debt, silver re-enters portfolios as a hard asset with asymmetric upside. Unlike gold, silver sits at a price point accessible to retail and emerging market buyers, broadening participation when confidence erodes. This creates a rare overlap. Industrial users want silver regardless of price. Monetary buyers want silver because of price volatility. Both groups draw from the same limited pool of physical metal. Demand is therefore no longer a single variable. It is a convergence. As long as silver was abundant, this overlap was manageable. But abundance is precisely what is disappearing. When structural demand meets constrained supply, the adjustment mechanism is not gradual. It is discontinuous. To see why, supply must be examined not in theory, but in practice. Silver supply is constrained by design, not by neglect, unlike copper, oil, or lithium. Silver is rarely mined because demand justifies it. Roughly 2/3 of global silver production comes as a byproduct of other metals, primarily copper, lead, zinc, and gold. This single fact defines the market. Silver output responds to base metal economics, not silver prices. When silver prices rise, production does not surge, it barely moves. Primary silver mines exist, but they represent a shrinking share of total output. Ore grades have declined steadily over the past decade. New discoveries are smaller, deeper, and more expensive to develop. Capital expenditure in mining has remained disciplined, shaped by shareholder pressure and regulatory uncertainty rather than commodity enthusiasm, even when prices signal opportunity. Timelines work against response. Bringing a new mine online takes 5 to 10 years. Permitting alone can consume most of that window. Environmental standards, community opposition, and geopolitical risk extend it further by the time new supply arrives. The cycle that justified investment often has already shifted. Recycling offers only limited relief. Silver is widely dispersed across electronics, medical equipment, and industrial components in quantities too small to recover efficiently. Recovery rates remain low. Solar panels lock silver into infrastructure for decades. This metal is consumed, not stored, as a result. the market has been running persistent deficits. Annual consumption exceeds annual supply, not by marginal amounts, but by structurally meaningful volumes. The difference has been filled by above-ground inventories built during periods of surplus. Those inventories are finite. That buffer is now thinning. Exchange vaults show steady withdrawals. Inventories classified as deliverable have declined faster than total holdings, signalling that the most liquid supply is being removed first. This is rational behaviour. In times of uncertainty, owners prefer control over optionality. Metal that can be demanded is metal that can disappear. The consequence is asymmetry. Demand can surge quickly, supply cannot. When that imbalance widens, price becomes the only lever capable of restoring equilibrium. But price does not need to rise to incentivise mining. It needs to rise to slow consumption. That distinction matters. In silver, higher prices do not unlock new metal. They ration existing metal. This is why traditional valuation anchors fail. Analysts project future prices assuming elastic supply curves that do not exist. They expect mean reversion, where structural scarcity dominates. They model silver like a commodity when it increasingly behaves like a constrained strategic input. The system holds together as long as inventories absorb the mismatch. Once they cannot, the adjustment shifts from gradual to abrupt. That is when pressure moves from geology to finance. The silver market does not break at the mine, it breaks at the clearinghouse. For decades, paper contracts have absorbed stress that physical supply could not. Futures, options, and ETFs expanded liquidity, compressed volatility, and gave the appearance of abundance. That system works only under one condition. Most participants must settle in cash, not metal. That assumption is now being tested. Open interest in silver futures represents multiple claims on each ounce of deliverable supply. Under normal circumstances, this leverage is invisible. Contracts are rolled, positions are netted, delivery is rare. But when physical demand tightens, leverage stops being theoretical. Early signals always appear in the margins. Lease rates spike as holders demand compensation to part with metal. Backwardation emerges, indicating buyers are willing to pay more today than tomorrow. These are not speculative anomalies. They are stress fractures. As stress rises, behaviour changes. Metal is reclassified from deliverable to non-deliverable. Inventory shifts from registered to eligible. Withdrawals accelerate. Each move is rational in isolation. Together, they reduce the pool of metal backing the paper market. This is where feedback loops form. Higher prices attract attention, but higher premiums attract fear. Industrial users begin sourcing directly rather than relying on exchanges. Investors question whether exposure represents ownership or settlement risk. Liquidity fragments. The paper price remains visible. The physical price diverges. History offers clear parallels. In 1980, rule changes ended the silver squeeze not by solving shortage, but by freezing participation. In the nickel market decades later, a delivery failure triggered exchange intervention and retroactive trade cancellations. Confidence survived, but only barely. These episodes share a pattern. When delivery becomes uncertain, markets prioritise stability over price discovery. That usually means changing rules. The problem for silver is scale. This is not a single concentrated position or a niche industrial metal. Silver sits at the intersection of energy, technology, and finance. A disorderly adjustment would ripple across multiple industries simultaneously. This is why institutional behaviour matters more than price targets. Banks do not wait for headlines. They adjust inventory classifications. They reduce exposure. They position defensively. Sovereign actors secure supply quietly. None of this requires panic. It only requires foresight, as long as the paper market remains credible. These actions stay incremental, but credibility is binary. It exists until it does not. Once confidence in delivery weakens, even temporarily, demand shifts abruptly from paper claims to physical control. At that point, price stops reflecting expectations. It reflects urgency. That is when linear forecasts fail, and that is when the range between $50, $100, and $500 stops being a question of optimism and becomes a question of system behaviour. Understanding that distinction leads directly to what comes next. Silver's future price is not a forecast problem. It is a pathway problem. Each price level implies a different outcome for the system supporting the market. The numbers are not arbitrary. They correspond to thresholds where behaviour changes. A move toward $50 represents normalisation, not crisis. This outcome assumes the paper market continues to function with credibility intact. Physical tightness persists, but delivery remains manageable. Industrial users absorb higher costs. Investors accept volatility without demanding metal. Supply deficits continue, but inventories decline slowly rather than abruptly. In this scenario, silver reprices higher, then stabilizes. That outcome is plausible. It is also fragile. A move toward $100 reflects structural recognition. At this level, the market acknowledges that silver is mispriced relative to its role. Gold-silver ratios compress. Industrial users secure long-term supply contracts. Premiums over spot widen and persist. Paper markets still operate, but physical demand increasingly dictates marginal pricing. This is not panic, it is adjustment. Historically, this is where silver tends to overshoot. Not because of speculation, but because the market underestimates how quickly confidence shifts once supply stress becomes visible. The $300 to $500 scenario is not about enthusiasm, it is about failure modes. Prices move into that range only if the paper-physical linkage breaks. Delivery becomes uncertain. Cash settlement replaces metal. Exchanges intervene to preserve order. At that point, price is no longer a signal, it is a rationing mechanism. The goal is not discovery, it is deterrence. This is how scarcity expresses itself in financial systems, not gradually, suddenly. The critical variable is not interest rates, inflation prints, or currency strength. It is behaviour at the margin. Do industrial buyers accept exposure to futures markets? Do large holders keep metal available for delivery? Do investors trust that claims represent ownership? As long as those answers remain yes, the upper range stays theoretical. When even one turns, no. Repricing accelerates. Timing remains uncertain. Path dependency is not. The longer deficits persist, the more likely the system transitions from liquidity-driven pricing to availability-driven pricing. Once that transition begins, historical anchors lose relevance. Silver has already exited the world where $20 or $30 define value. The next regime will be defined by how much stress the system can absorb before changing its rules. That is why the question is no longer whether silver rises. It is which version of the market sets the price when it does. Silver is no longer telling a story about price. It is telling a story about systems. For decades, silver was treated as a marginal asset, volatile and expendable. That perception allowed its market structure to grow increasingly abstract, increasingly leveraged, and increasingly detached from physical reality. What is happening now is not a rally correcting undervaluation. It is a confrontation between abstraction and constraint. Every major signal points in the same direction. Persistent supply deficits, industrial demand that cannot pause, inventories that decline regardless of price, institutional behaviour that prioritises control over yield. These are not speculative signals, they are defensive ones. This is why Wall Street's forecasts keep failing. They are built for equilibrium markets. Silver is moving into a disequilibrium phase when equilibrium breaks. Prices do not respond smoothly. They gap, they overshoot, they force decisions. In those moments, the market does not ask what silver should be worth. It asks how much is needed to change behaviour. That is why the $50, $100, and $500 debate misses the point. Each number reflects a different degree of stress tolerant in the system. $50 assumes confidence holds, $100 assumes recognition spreads, $500 assumes trust breaks. History suggests that markets rarely stop at recognition, they stop at resolution. Silver sits uniquely exposed to this process because it is both monetary and industrial, both scarce and essential. It cannot be printed, it cannot be substituted at scale, and it cannot be produced on demand. That combination leaves price as the only remaining adjustment mechanism. The longer that adjustment is delayed, the more abrupt it becomes. This does not guarantee an outcome, but it defines the risk. And risk, not optimism, is what markets eventually price. Silver is no longer an ignored asset searching for attention. It is a constrained input testing the limits of a financial structure built on confidence. How that test resolves will determine whether today's prices are remembered as excess or as early.